Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Thursday afternoon, we have Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for an update on technical levels to watch in the Nasdaq-100 as we rally into the close. In fact, the Nasdaq-100 outperforming the other major averages and on a three-day win streak. So, Brian, I guess the question is how markets are reacting to the Fed rate hike. Do we kind of pull the Band-Aid off and provide a little bit of certainty there? And then the other question is, of course, have we hit the bottom, or is this a bear market rally? We know how scary these bear market rallies can be.
Yeah, bear market rallies can certainly be, much stronger in the short term, say, than what you would typically see in a bull market. So they can be, quite vicious. We call that the B wave in Elliott wave terms. I think the Fed yesterday was, I think it's widely believed they were much more hawkish than people were expecting them to sound, similar to what the ECB was recently at their last meeting. And we can see that by the two-year Treasury yield, which is often viewed as barometer what the Fed's going to do. That rallied about 12, 13 bips up to the 2% level. It's pulled back now to about 193. But, we did see the long end, a little volatility there, but I think spreads, 210s, spreads, 30s and 5s, relatively stable after, recently, a steep downtrend. So, but as you noted, the markets and stocks have rebounded. We've certainly, have seen some oversold technical conditions. Last week, we noted that we could see a near-term relief rally. I think what Powell said in his meeting, in his press conference afterwards, maybe is delivering some confidence. He noted that the economy is very strong and well positioned to handle tighter monetary policy. He highlighted, strong wages, which is inflationary, but puts the consumer in a better position. In saying that, he didn't say anything about real wages, which are certainly falling, given the strong inflationary trends.
Right. So, Brian, I guess really what we need to do is take a look here at a chart of the Nasdaq-100 and get a little bit of a longer-term picture, because as you had noted, what's that expression? Bear market rallies can be like a face-ripping off kind of rally. So, is there anything that you can see in the technical levels that suggest that this could potentially be a recovery going forward? I mean, because again, at the end of the day, from a fundamental perspective, this market, outside of earnings especially, is really being driven by, of course, the Ukraine crisis, supply chains, and inflation.
Yeah, and the supply chains and inflation, they kind of go hand in hand. The Ukraine crisis is relatively recent. It's about 3.5 weeks ago or so, 3 to 4 weeks. The inflation problem has been building, since late 2020, early 2021. Only in November did the Fed finally, with egg on its face, drop the term transitory. As far as the Nasdaq-100, the longer term view, I'm looking right now at the retracement levels from the 2020 low to the 2022 high, the Fibonacci retracements. So the recent lows that we first made in late February, the week of the 25th, we kind of retested them this week. Is right in line with that 38.2% Fibonacci retracement. An expected support level certainly doesn't have to stop there, but certainly can be. And other technical signals like breadth argued that we could see a rally off the lows, and so we're seeing that now. It's way too early, in my opinion, to say that the low is in for this pullback, and now we're going to resume higher. At the very least, what we want to see right now is this pivot here, the support level around 14,385. See what the Nasdaq-100 can do there. If we know technology is a big sector in this space, and it's bouncing nicely off the lows. The second biggest group is consumer discretionary, and look where this is right now. So this is up against a big test, a support level that was first established back in July 21. Prior support can often turn into resistance. So there's going to be a lot of tests looking forward for the indices, the Nasdaq-100, to prove itself. Can it get above these certain levels and thresholds? I would expect that in the near term, the run higher is still in the early stages, and we can get back up there.
Actually, Brian, keep that chart up for 1 second. If you could go back to the
Sure.
chart that you just had. So we see that COVID bounce there, right? We had that, I guess, sell-off, 4 to 6 week sell-off in March and April of 2020, and then it's like the velocity of how it dropped and then recovered feels a little bit different than this time, where the volatility is a bit more prolonged. I mean, we've been kind of dealing in this environment since December, so it kind of lends to that argument that we might have, a little bit more either sideways or bearish reaction before we can establish that new trend. It just feels like a more longer volatile time frame.
Yeah, I mean, if we want to, we haven't really had any sort of significant bounce really off the lows. When we look at that first downtrend, and let me zoom in a little bit here, that first downtrend in the month of January, when we rallied back higher from there, if you want to look at that retracement, we could see that got about the 50% Fibonacci retracement of that initial move. So now if we want to see where potentially this next bounce can go, if we do 50% again, that could take us up to 14,892. The 61% retracement would take us all the way up to 15,335. There, I don't know if the short interest really has elevated all too much during these last 2 months with the downtrend. So I don't know how much move there is from a potential short squeeze in the near term. My concern is if the Fed is going to be as aggressive as it says it's going to be, what they're essentially telling you is they're looking to crush the demand side or to reduce the demand side in order to bring down inflation. So they have to, maneuver that soft landing. Is that doable? We just have to wait and see. Can the Treasury market handle that? There's two mandates by the Fed: inflation and growth, inflation/growth, and then unemployment. As they try and bring down inflation to meet that mandate, there's also what some say is that there's a third mandate: a functioning Treasury market.
Well, liquidity, of course.
Yeah. So in 2019, when we saw the overnight lending rates, spike from basis points all the way up to 7, 8, 9% just before Fed meeting, that seems to be a function of a problem in the Treasury market in certain areas. And so, will something similar or some other kind of problem surface as they tighten? The curve is, and then to look at growth and economic activity, everyone's looking at that flattening yield curve. It still has not yet inverted the 2s10 spread.
Right.
And even when it does, there's usually a considerable amount of time, at least 6 months, if not 12 months or longer, before we see the market really be impacted by that. Again, every time is different. We're now in an inflationary environment where we haven't been, certainly, in my career. So, we'll just have to wait and see how this time plays out.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.